Hello everyone. Today we'll be talking about income statement. Any company which is listed in the stock market will have a regular meetings with the shareholders to discuss about the financial performance in the previous accounting period. So in the discussion with the shareholders, there will be a few financial statements which the company would be talking about to the shareholders. One such financial statement is the income statement. So the income statement uh, so the income statement measures the company's financial performance over a specific accounting period. In the previous accounting period, the company the excuse me, the company's revenues and expenses which has happened the previous accounting period are measured and written down in a statement which is called as income statement. Now we will be seeing about the components of an income statement. So these are the components of an income statement. We'll explain the components by taking an example. The example which we are going to take today is a manufacturing company, a bike manufacturing company, a fictional company called ACS. Let's say there's a company called ACS which manufactures bikes. So when they sell bikes, they get revenue out of selling bikes. That is called as revenue from operating activity. So operational activity in this case is bikes, creating bikes and selling bikes, manufacturing bikes and selling bikes. Since they're getting revenue out of that operating activity which is selling bike, whatever money they get from selling bikes will come under the heading revenue from operating activities. uh, so next up is revenue from non-operating activity. Let's say this company ACS has a land and they have sold this land in the previous accounting period. By selling this land, they will have got some money. So even though it's revenue, they haven't got this money out of their operating activity. They have got this money out of a non-operating activity called selling land. So even though it's revenue for them, it's from a non-operating activity. So that's why this particular revenue will be tagged under revenue from non-operating activity. So these two would be summed up, revenue from operating activity and revenue from non-operating activity. These two would be summed up to arrive at the final revenue of a company. So next up, so after revenue, what would be there? Expenses. So to manufacture a bike, the company ACS would have some raw materials like brakes, clutches. Those raw materials would have incurred some cost. So the cost which they would have incurred to manufacture a bike, that would come under expenses from operating activity. So next up is expense from non-operating activity. What non-operating activity expense can happen for a bike manufacturing company? Let's say they have taken an insurance. Everyone, you guys would be aware of the floods which happened in Chennai last year. So if that kind of natural calamity happens, the manufacturing unit might incur some losses. So to avoid those losses, the company would have taken an insurance. So that's an expense for a company. The expense they have incurred, it's not an operating expense, it's a non-operating expense. So this expense would come under non-operating activity. So these so uh, we'll take the revenues and expenses. We'll add up the revenues from operating and non-operating, and we'll subtract the expenses from operating and expenses from non-operating to arrive at something called EBITDA, which means that earnings before interest, tax, depreciation, amortization. So after we add up the revenue and subtract the expenses, we arrive at something called uh, earnings before interest, tax, depreciation, amortization. So after this after this we are going to subtract two items from EBITDA to arrive at EBIT, which is depreciation and amortization. So what does depreciation mean? Okay, so to manufacture a bike, the company ACS will have a manufacturing unit where there'll be machines. So let's say before the start of the previous accounting period, the machine cost was assuming 10 lakhs, and after the accounting period it's 9 lakhs. So if they want to sell the machine now, it will cost 9 lakhs, not 10 lakhs. So the machine will have depreciated by 1 lakh. So this particular expense, 1 lakh, even though they are not spending this money out, it's an non-expense, it's an non-outgoing expense. So this will also be treated expense. This is called depreciation, and that will be subtracted from EBITDA. That will get subtracted here. And next up is amortization. What's amortization? Let's say ACS has a brand value. It's Amortization basically is a depreciation of a non-tangible asset. Previously we were talking about depreciation, that's a depreciation of a tangible asset, which is a machine. Now we are talking about depreciation of non-tangible asset, which is a brand value. Let's say the brand value of ACS has gone down by some amount. So since it has gone down, we had to subtract that from EBITDA. So now after subtracting depreciation and amortization, we'll arrive at something called earnings before interest and taxes. Okay, so we have got some money, the company has got some money, but it hasn't paid the interest and taxes till now. Now after we get arrive at this, we'll subtract the interest expenses from this EBIT. So what does interest expense mean? So, see, a company which is manufacturing a bike would have taken a loan from, it wants money, it needs money to manufacture bikes, it needs money to buy raw materials. So, to get this money, they would have taken a loan from a bank. So, if they would have taken a loan, they would be paying interest to a bank. So, that interest expense they would be paying monthly. So in the previous accounting period, if they would have paid any interest expense, that also goes out of the company and it should get subtracted from the earnings. So from EBIT we subtract the interest expenses to arrive at profit before taxes. So now we are arriving at some value which will stay with the company, which is profit before taxes, which is so part of the money will stay with the company. So obviously we need to pay taxes to the governments. uh, so the money which we get here, profit before taxes, from that we subtract the tax which is paid to the government. After we sub excuse me After we subtract tax to the government, we arrive at something called profit after taxes, which is the actual profit which the company earns in the past accounting period. Example of this, let's say ACS, they have got a revenue of 7650 crores in the previous accounting period, and they have got a revenue from non-operating activity like selling of land of 420 crores. Expenses, operating non-operating, is 4500 300 crores. The EBITDA would be around 3270 crores, and they subtract amortization and depreciation from the EBITDA. They arrive at earnings before interest and taxes. Let's say they pay interest of $200, 200 crores, and then they arrive at a profit before tax of 2770 crores, and then they pay a tax of 831 crores, and then they end up having a profit of 1939 crores. So this is the earning which the company ACS has got in the previous accounting statement. From this earning, dividends can be given to shareholders. That we'll see in the next video.